Hello and welcome to our Friday edition of CMS Forex News. I'm your market analyst Nick Nassad. Today is March 13, 2009. New Zealand retail sales fell 1.1% in January compared to December, as sales of motor vehicles were down 11% and New Zealanders spent 2.6% less on fuel. Excluding the auto sector, the core rate of retail sales actually showed a bigger than expected increase of 0.3%. The New Zealand dollar-Japanese yen pair rose higher today, extending its gains from yesterday. Despite the weaker headline retail sales data from New Zealand, the Kiwi was boosted by risk appetite in Asian and European equity markets that rallied following yesterday's rise in U.S. stocks. That helped the Kiwi move to its highest level against the yen since January 12th at the 51.85 level, and the pair now is at its resistance from an upward channel started in mid-February. In Switzerland, producer and import prices fell 0.6% in February compared to January, and were down 1.8% in annual terms, accelerating a pace of falling prices that may pose the threat of deflation in the economy. A strong Swiss franc is making imports cheaper from abroad, and may be part of the reason that the Swiss National Bank decided to intervene in currency markets to weaken the franc. Import prices are now down 5% on the year. Eurozone retail sales rose 0.1% on the month in January, though the annual rate showed its 8th straight decline at negative 2.2%, the longest run of annual declines on record. The data shows that the usual post-Christmas discounts did little to get shoppers to open up their wallets in January. Also, December's data was revised down to show weaker spending. The euro-yen pair climbed higher to test the 127.69 level in today's session, which moves the pair above resistance near the 126 level that had held the last 3 weeks. As we mentioned before, European stocks rallied, helping to boost risk appetite, but the euro rally stalled in New York trading as U.S. stocks moved into negative territory in at least the morning session. The euro-franc pair, following its surge yesterday, rose higher to the 1.54 area, though today's session saw a marked decrease in volatility in the pair. The U.S. trade deficit narrowed more than expected in January, coming in at a deficit of $36 billion. That was the smallest trade gap in 6 years and was mainly driven by a larger fall in imports that outpaced the fall in exports. Imports were down 6.7% as Americans cut back on spending on oil and foreign cars. The U.S. spent $4.3 billion less on purchase of crude oil, and demand for automobiles dropped by $3.3 billion. Of course, global trade is falling both ways, and U.S. exports fell by 5.7% on the month, reflecting the weakening demand abroad for U.S. goods. That should continue to pressure the U.S. manufacturing sector. U.S. import prices fell 0.2% on the month, the 7th month of decline, though the fall was smaller than anticipated. The 12.8% annual drop was the biggest since the index was first published in 1982. Meanwhile, consumer sentiment throughout the middle of March held largely stable to February's levels. The UMich index was at 56.6, which beat expectations on the upside. The euro-dollar pair consolidated in a range between 1.2870 and 1.2960 in today's session, managing to hold on to most of the gains it has accumulated this week. It remains to be seen if the recent euro strength persists next week and in the weeks to come. The pound-dollar pair, meanwhile, fell below the 1.39 level overnight as the pair retraced part of yesterday's late rally. Following that kickback, the pound jumped higher in the European session as stocks in London started strong. The pound reached the 1.4070 level before stalling and reversing part of those gains in New York trading. In Canada, the economy shed 82.6 thousand jobs in February, a larger fall in employment than was expected. There were 111,000 full-time jobs lost, while part-time work edged up slightly. The unemployment rate rose by 0.5% to 7.7% from January's 7.2%. The Canadian trade balance added a second piece of negative fundamental news, as January saw a record $1 billion Canadian dollar deficit. Exports fell 9%, while imports were down 7.9%, a large reduction in trade precipitated by weaker car sales abroad. Lower imports of automotive products and machinery and equipment accounted for nearly 3/4 of the monthly decline in imports for January. The US dollar Canadian dollar pair, which hit an intraday high of 1.2840 prior to the Canadian news, fell in favor of the loonie, finding support at the 1.2625 level. The Canadian dollar was able to shrug off its negative fundamental news and gained as investor sentiment turned for the better this week. Next week, we get producer and consumer price data from the US, along with another FOMC meeting. Other important releases include UK employment data, retail sales from Canada, and the ZEW Economic Sentiment Index from Germany and the Eurozone. And that wraps up our coverage of the Forex markets this week. Thank you very much for joining us here at CMSFX.com. And from all of us here, have a great weekend.